What if you could learn how to think like a billionaire investor in just 10 minutes? Warren Buffett's 1980 shareholder letter is packed with simple but powerful lessons for investors, especially beginners. Today, we break it all down into 15 lessons using plain language and real-life examples. Let's get started. Lesson 1. Focus on return on equity, not just earnings. Buffett says, earnings per share might sound impressive, but what really matters is how well a company uses your money. That's called return on equity, or ROE. Think of it like this. If a friend borrows Rs 100 and returns Rs 110, he gave you a 10% return. But if he needed Rs 1000 to give you that same Rs 10, that's just 1%. Always ask, how efficiently is this company growing my investment? Takeaway, judge management by how well they grow your equity, not just earnings. Lesson 2. Retained earnings must work for shareholders. Companies often keep their profits instead of paying them out. That's fine. But Buffett says they should use that money to grow the business. If it just sits there or is spent poorly, it's wasted. As a shareholder, you deserve a return on every dollar kept. Takeaway, if profits are kept, they must grow. Lesson 3. Smart share buybacks create wealth. When a company buys back its own stock, your share becomes more valuable if it buys at a low price. But buying back overpriced stock destroys value. Buffett only supports buybacks when shares are cheap and it benefits remaining owners. Takeaway, buybacks build wealth only if done wisely. Lesson 4. Real wealth is what you can buy, not just what you earn. Buffett reminds us, inflation steals your buying power. Even if your salary or investment grows, rising prices might eat it all away, so the focus should be on real returns after inflation. Takeaway, true wealth is measured by purchasing power, not just numbers. Lesson 5. Reinvestment plus time equals sign magic. Buffett didn't chase fast gains. He reinvested profits carefully and let time do the heavy lifting. This is called compounding, and it's how wealth grows quietly but massively. Takeaway, the best returns come from patient reinvestment. Lesson 6. Don't rely on averages. Understand the business. Buffett warns that industry averages can be misleading. Two insurance companies might look the same on paper, but one could be doing risky business. Look at how the company actually earns money and uses capital. Takeaway, forget averages. Study the actual business model. Lesson 7. Great managers matter more than metrics. Buffett loved leaders like Jack Byrne at Geico, people who were honest, smart, and long-term thinkers. A great manager can transform a business, even during tough times. Takeaway, back the people, not just the product. Lesson 8. You don't need full ownership to win. Buffett didn't buy every company he liked. Sometimes he just bought stock. Even a small piece of a great company can be incredibly rewarding. As a shareholder, you benefit from its growth. Takeaway, you don't need to control the business, just own the right part. Lesson 9. Inflation quietly eats returns. Inflation is like a silent tax. Buffett says it reduces the value of future cash flows. So businesses must grow faster than inflation, or they're losing value. Takeaway, if your investment doesn't beat inflation, it's falling behind. Lesson 10. Float can be a free weapon if handled right. In insurance, customers pay today but claims come later. This float is money that can be invested for free if the business prices risk carefully. Buffett mastered this at Geico. Takeaway, float is like borrowed money you don't pay interest on. Lesson 11. Avoid businesses that eat all their profits. Some companies earn money but spend it all just to stay alive. That means zero real returns for you. Buffett avoids capital-intensive traps like this. Takeaway, look for businesses that generate free cash, not just survive. Lesson 12. Debt is a tool, not a lifeline. Buffett used debt only when it was safe, long-term, and optional. Bad debt equals sign desperation. Good debt equals sign strategic flexibility. Takeaway, use debt when you don't need it, never when you're forced to. Buffett tried to save a dying textile business. It failed. He learned, don't invest in hope, invest in working businesses. Takeaway, buy working engines, not ones that need fixing. Lesson 14. Accounting can mislead. Many companies report profits using old asset values. Buffett says this creates an illusion of health. You must read beyond the headlines and analyze what the numbers really mean. Takeaway: learn to spot the story behind the numbers. Lesson 15. Integrity is an investment advantage. Buffett admired leaders like Eugene Begg, people who built wealth through trust and honesty. Over time, integrity attracts better opportunities, partnerships, and results. Takeaway: in business and investing, trust is worth gold. Which lesson opened your eyes today? Drop your favorite in the comments, hit like and subscribe to keep learning timeless investment lessons, Buffett style. Buffett didn't get rich overnight. He made smart choices, reinvested wisely, and never stopped learning. Now it's your turn. Think long-term, stay disciplined, and invest like Buffett.